Qualcomm, one of the larger semiconductor companies, has seen poor financial performance in 2023 so far. The company's revenue decreased by 23%, indicating a downtrend in sales, and their Q3 net income is down 52% year over year as well. The stock has been flat in price action this year with no gains and also no losses, even when other tech stocks have been rallying. This is mainly due to the cyclicality of Qualcomm. Today we'll be taking a 3-step approach to thoroughly evaluate Qualcomm and determine its fair value. Step 1. Margin of safety. In this step we'll look at Qualcomm's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Qualcomm's financial statement and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to get an insight into value of Qualcomm's business. By using these models, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Qualcomm as an investment opportunity. To determine this final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. The EBIT has gone up over the years, going from $7.8 billion in 2013 to almost $16 billion in 2022. The average EBIT growth during this period is 16%, which is a 5% deduction in the margin of safety. Looking at the margin, it has also gone up over the years, going from 32% in 2013 to 36% in 2022. The average margin growth during this period is then 6.2%, which is way past the green part of our scale, indicating another 5% deduction in the margin of safety. Next metrics we'll be looking at are the dividend growth and the payout ratio. Dividends have gone up nicely over the years, going from $1.40 a share in 2014 to $3.20 a share in 2023. The average dividend growth during this period has been sitting at 9.7%, which is a 5% deduction from a margin of safety. This dividend is supported by a payout ratio that is currently sitting at a nice 40%, meaning that they have a lot of room left to increase their dividends further. This is no change in the margin of safety though. And the final metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For Qualcomm, this is under 1 year, in this case a 69% debt to EBITDA ratio, which is very low, awarding them with a 5% deduction in a margin of safety. The return on invested capital for Qualcomm is sitting at a very high 30, indicating that the management is very effective at allocating capital, which once again awards them with a 5% deduction in a margin of safety. Looking very good so far for Qualcomm. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Qualcomm going from 2013 to 2022. The average growth rate in their free cash flow annually has been sitting at just under 17%, and I'm projecting their future free cash flow to grow by 8% annually for the next 10 years, and with this percentage we'll determine the future free cash flow for Qualcomm and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $173.2 billion, and to get to our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $164.1 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $146.57, which is an upside of almost 33%. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Qualcomm going from 4 years ago to the current year. Their average growth rate in their dividends during this period has been sitting at 6.6%, and I'm projecting this growth rate to continue with an expected growth rate in all of their future dividends of 6.5%. I'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $170.40, which is an upside of over 54%. Third model that we'll be looking at is the Graham's revised valuation formula. In this model, we take a look at the earnings per share that Qualcomm is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of only $49.77 out of this valuation model, which is a downside of almost 55%. The next model we'll be looking at is the multiple valuation. In the multiple valuation, we'll be looking at similar companies to Qualcomm, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 21.67. All that's left to do then to get a fair value of this model is to multiply by the earnings per share that Qualcomm is generating, which is $7.64 a share, giving us a fair value of $165.53, which is an upside of almost 50%, meaning that's significantly more undervalued compared to its peers. And the last model that we'll be using is the mean reversion theory. In mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average, it has been sitting at 2.59%. While the current dividend yield stands at 3.01%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 22.07, while the current PE ratio is sitting at 14.46, indicating that it's slightly cheaper than its historical average. And this gives us a fair value of this model of $148.66, which is an upside of almost 35%. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, mean reversion theory, price per share, giving us an average of $136.19. A margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, EBIT growth, margin growth, return on invested capital, and dividend growth, leaving us with no margin of safety at all, meaning that the average out of our models is the fair value out of our valuation, which is then $136.19, and with the current price of $110.54 a share, we get an upside of over 23%, indicating that's a buy per all valuation. If you want to get access to all of these models that I use in my videos and much more, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.